The Super Bowl is over, which means it is tax time on the Capital Stewards Podcast. This is our annual tax guide episode where we'll talk about all things related to reducing your taxes, which, not surprisingly, is a popular topic. So today we're going to cover smaller opportunities to reduce your 2025 taxes, the taxes that you're preparing now or about to start preparing, and then also planning strategies to create more significant tax reductions over the long term. This year, we don't have as much policy uncertainty since the OBBBA passed last summer, but it does have implications, obviously, for your 2025 taxes and for planning for 2026 and beyond. So we'll talk about those changes here as well. But as we usually do in this episode, let's talk about those Super Bowl ads. Remember to score well on the official Brian's Super Bowl ad-o-meter. Your ad must be memorable, serious, or funny, and it also must be relevant to your business. I saw several ads this year that captured my attention, only to leave me asking how the spot was even remotely related to what they were trying to accomplish. So you have to meet both criteria. For example, this year, I really liked American Icon's Budweiser spot where the Clydesdale helps the eagle, the young eagle chick, and then it eventually turns into a soaring eagle. It was really beautiful, but I have no idea why I should drink Budweiser because of that ad. The same with Dunkin's spot that had every celebrity imaginable. No idea what that had to do with donuts. So for this year, I have two honorable mentions because the spot was almost so good, I wanted to believe them. First is Lay's for the Idaho potato farmer ad, where they turn the farm over to the next generation in the family. The problem is when you look at a Lay's potato chip, there isn't really that much potato in the chip. So that's a good try. The second in this category is Pepsi. I thought making fun of the Coca-Cola bear with a blind taste testing, have the bear choose Pepsi Zero over Coke Zero, and then go to therapy was a great story. But we all know that humans and bears prefer Coca-Cola. So I kind of kicked that one out as well. My winner this year was Anthropic. I thought both of their spots feature someone talking to AI personified by a person that begins answering their real question and then turns the response into an ad. I thought the spots were memorable and they suggested a real benefit to the product, which namely is that it's going to stay ad-free, at least for now. So that's my take on Super Bowl ad season for 2026. All right. Now that the Super Bowl is over, we can turn to baseball season. Taxes. So, all right, let's dive in. Before we dive into strategies and ideas to reduce your 2025 taxes, it's important to remember that tax reduction is a long-term game. Smart tax planning is not an annual hunt for deductions. If you've listened to this episode before, you've heard me say this. It's even more true now because we had the Trump tax cuts in 2017, the OBBBA, all that stuff has increased the standard deduction and it's taken away a lot of the itemized deductions and it's kind of overall simplified the tax code. So the deduction hunt every year isn't as fruitful as it was maybe 10 years ago. The best way to minimize your taxes are through long-term strategies. That's investing in the right types of accounts, think retirement IRAs, 401ks, Roths, structuring your business entities appropriately, so whether or not you're making S-corp elections, partnerships, et cetera, and then managing your taxable income through accelerations and deferrals. So if your tax planning starts every year in March or April, you really need to consider working with your CPA or with a financial advisor to create a more efficient, tax-efficient long-term plan. That's where the real juice is at. So like always, I'll take this guide in two parts. The first is things that might turn the dial a little bit, might make some small changes that'll help us out a bit for 2025, help with the margins. And then the second half is those longer-term opportunities that I think can really move the needle over time. So let's talk a little bit about 2025. There are higher standard deductions in 2025. As usual, the standard deduction goes up a little bit each year. For the 2025 tax year, the standard deduction rose up to $31,500 for married couples, $15,750 for singles. More importantly than the traditional standard deduction is that enhanced senior deduction that came through OBBBA over the summer. That's an additional $6,000 per person or $12,000 for couples if you're able to manage your taxable income appropriately. That full senior deduction only applies to seniors with less than $75,000 in income as individuals or $150,000 in income. Then the deduction starts to fade out and then eventually goes away. But Say you're a retired couple and you're spending $300,000, but if you've got $50,000 or $100,000 coming out of a Roth or out of a taxable portfolio, you still qualify for a big chunk of that senior deduction. So we'll talk about this more later on, but this just goes to show you the value of smart planning over the long term, which gives you control of your taxable income when it matters most, so that you can get those big deductions when you're in retirement. This enhanced senior deduction, by the way, you may have heard about like no tax on Social Security. This is effectively that, right? So what it does is it takes away the tax that may have been owed by some people on Social Security. It's not a complete exemption of Social Security tax or tax on Social Security, but it does cover a lot of the bills. So that enhanced senior deduction, really important, but pay attention to those income limits and make sure you stay under those if you can do that. So there's kind of a new, I'll call these the big three deductions. The OBBBA introduced three major deductions that you might be eligible for starting with your 2025 tax return. So the first is no tax on tips. If you work in the service industry and sort of customarily you get tips, then you might be able to deduct that income. The IRS has published guidance on which industries qualify for this deduction. And it's all the places you might think: restaurants, hotel workers, places where you normally leave tips today. So my investment and financial planning practice is not going to start working on a tipped basis just to get the tax deduction. The IRS says, hey, you can't do that. So if you're thinking about maybe moving your business model to that, that's not going to work for you. Like other deductions, this phases out at higher income levels. Think around $300,000 for a married couple. And of course, you actually have to report the tips on your 1099 or on a W-2 to get the deduction. You can't claim the deduction on unreported cash tips because we all know you would never have unreported income anyway. No tax on overtime. So this is the second big deduction. Eligible workers can deduct about $12,500 of overtime pay, $25,000 for a married couple. Same kind of phase out schedule applies as the no tax on tips. So if you're married, that's $300,000 of income, or half of that if you're single. Key thing to remember here is this only applies to the overtime portion of your pay. So for example, if you make $25 an hour in sort of standard pay, and then you make $35 an hour in overtime or $40 an hour in overtime, it's only that $10 or $15 difference that's deductible, not the entire $35 that you earned for those hours. That's something, make sure you understand that. If you have employees, right, if you're running a business and you've got folks that are working overtime, make sure that they understand that as well. Car loan interest. You can now write off $10,000 in interest on loans for new vehicles, provided that they were assembled in the United States. The key here is to know where the final assembly point for that vehicle occurred, because brand is not going to help you as much as you think. Some Mercedes-Benz SUVs are assembled right here in Alabama. Some Ford trucks are assembled in Mexico. So you need to confirm the assembly with the dealer before you buy if you want to get that deduction. Like the other deductions, this one phases out starting at $100,000 of income for single folks, $200,000 for joint filers. So it phases out as you get into the higher income tax brackets. The deduction here is helpful, but if you think about the total interest over the life of, say, a $50,000 5-year car loan at average interest rates, that total interest is just under $10,000. So if you're in the 24% tax bracket where you really qualify for this whole deduction, it's about a $2,400 benefit. So if you're choosing between new and used, the new car difference, the price difference, so likely to be more than the tax benefit you're going to get. But it is $2,500 and it does help over time. So the next one is less of an issue in our footprint in the Southeast, but it's the dreaded $10,000 cap on state and local income taxes, or the SALT deductions. Those have been quadrupled essentially to $40,000 for most taxpayers. So, and then as your income gets up through $500,000, that one scales back as well. So if you are a really high income earner and you pay a lot of state and local taxes, then you've got up to $40,000 there that can be deducted from your federal return. So, shifting away from deductions a bit, you still have time to reduce your income from last year by making contributions to different types of tax sheltered accounts. One thing that you can do, we talk about this almost every year, you can open a health savings account. If you have material medical expenses, which is virtually everyone, because eventually you will have healthcare expenses, then an HSA is a great way to reduce your long-term tax liability. HSAs, they get what I call the trifecta of tax deductions. The contributions are tax deductible, the account grows tax-free, and then the distributions for those qualified healthcare expenses and even some Medicare premiums are not taxed. So even if your medical expenses are not higher than the 7.5% of income that allows them to be deductible in your return, and HSA is still a good tax reduction strategy. And like retirement accounts, you can still open and contribute to an HSA for last year until you file your taxes in April 15th of 2026. Retirement account contributions similar story here, right? You have until the April tax deadline to contribute to retirement accounts for 2025. So if your income is relatively high last year, think about making IRA contributions to receive a tax deduction now. However, I caution folks against doing this blindly every single year. If your income last year was lower than usual, then you might want to pay taxes now and get capital gains treatment or potentially tax-free treatment through Roth assets on future investment gains. So you want to look at your taxable income and make sure that those contributions are right. The other thing to remember is that not all IRA contributions are tax deductible. And so putting money into an IRA and not getting the tax deduction is kind of a raw deal because you're going to pay taxes now and you're going to pay taxes again when the money comes out. So you want to be cognizant of what your tax bracket is and where it's going to go before you make that contribution. But if you are looking for a way to reduce your income, then you can make those contributions until the tax deadline. All right, so let's shift gears. Oh, actually, let's talk about one more thing for last year, and that's the amount of your refund. So part of what happened in the OBBBA last year was that the government changed some of the tax rates, and they didn't update the withholding tables that most people were using. So for a lot of folks, you're going to find that you sort of over withheld last year, and you're withholding too much money from your paycheck, and you should be withholding less, and you're going to get a pretty big refund this spring. So when you go through to your taxes, if you're still withholding the same amount that you were withholding last year and you're getting a big refund, that's probably a good opportunity to reduce your withholding so that you're not sort of giving the government that interest-free loan every year. So check out your withholding, especially if you get a big refund check. Remember, big refund checks feel nice, but I'd rather you just take the money and put it in a savings account throughout the year instead of waiting until April and giving the government the money on an interest-free basis over time. So, all right, let's shift gears a little bit and talk about strategies to reduce taxes over the long term. We recommend that clients have both Roth and traditional retirement accounts. Properly allocating cash flow between your Roth and your traditional retirement accounts is one of the most valuable long-term tax planning moves that we see with clients every single year, without fail. Remember that everyone has access to Roth style accounts, even either through your employer, through a solo 401k plan, regardless of your income. So in the past, 10 years ago, we're like, hey, maybe I make too much money to really consider Roth. That's not the case anymore. You should talk to somebody about solo 401ks or the Roth side of your employer plan. And you want to look to fund those Roth accounts when your income is relatively low, and in traditional accounts when the deduction is more valuable and your income is relatively high. Now, those numbers are different for every person. So what's relatively low and relatively high will differ depending on what your income is over your lifetime. So it's important that you look at your situation and figure out, hey, how much money do I make now? How much money might I make in retirement? What my taxable income might be in retirement? How do those things compare? And then that drives the decision around whether you should be making Roth contributions or not. I mentioned this earlier, like most deductions, IRA deductions phase out as your income grows. So again, if you're just blindly putting money into an IRA and not getting a tax deduction for it, that's not a great strategy. Remember, if you own a business or if you're self-employed, you actually can contribute to your retirement account to a 401k or the different kinds of IRAs as both an employee and an employer. So particularly in those solo 401ks, you've got upwards of like $60,000 of tax deferral contribution power. So there's a lot of horsepower in making retirement account contributions when it's the appropriate thing to do. Other long-term strategies, tax loss harvesting. You might be thinking markets were up last year. It's unlikely that every single one of your investments increased in value throughout all of last year, though. Remember in April, it's kind of distant memory now, but we had a significant market decline around Liberation Day. And so if you should have been selling losers around Liberation Day, realizing those losses, immediately reinvesting so that you rode the wave back up through the rest of the year. But if you had those losses, you could write some of those off on your tax return this year and roll them forward to cover future capital gains. So it's really important that you're actively tax loss harvesting throughout the year. That can be worth a lot of money over time. Bunching charitable deductions. If you normally give to charity every single year, consider giving less in one year and substantially more in the next. Especially if bunching your deductions allows you to give more than the standard deduction in 1 year. So the standard deduction, $31,500. So if you're thinking, hey, I want to give $40,000 or $50,000 to charity, what you really want to do is give all of that in 1 year, maybe in December, and then skip a year, and then maybe the next January you give double the amount so that you can write all of that off on your taxes. Controlling business income. This is something I talk to a lot of business owners about. If you are a partner or an outright owner of a business, you might be able to influence whether the business pays income, realizes expenses, sells assets in a given year. And part of that calculus here now involves the OBBBA 100% bonus depreciation allowance. So that allows you to take the expense from some types of equipment that you buy when you purchase it all in 1 year, as opposed to deducting it over the equipment's lifetime through normal kind of depreciation schedules. That helps you reduce your cash tax bill the year that you buy that new equipment, even if that asset has longer term value. So managing your business income and thinking about, hey, where do I want to use that bonus depreciation? How do I use that to help offset those years when the business it does really well and I've got a lot of income coming in? You want to work with your advisors, work with your tax team to help avoid spikes that lead to those kind of higher tax rates in like one-off years. And so you can use some of those strategies, controlling your income, deductions, bonus depreciation, to kind of control for some of those things. If you're a small business owner, don't forget that QBI is now permanent. So that's not a net change for last year, but there was this potential for it to expire. And so that's very, very important. 20% of your business income tax deduction is really powerful. And so now you don't have to worry about that going away over time. Net investment income taxes. If your modified adjusted gross income is above $250,000 if you're married, or $200,000 if you're single, then you might be exposed to the net investment income surtax at 3.8%. This is just a free extra tax you get to pay if you're a high income owner on your capital gains. That also includes income from S corps for business owners. So if you're not meeting the thresholds for kind of active involvement. So you want to consider active measures to control taxable income if you're hovering right around that $250,000 income threshold. Health savings accounts. Like I mentioned earlier, HSAs are the trifecta: tax deductible income for contributions, tax-free growth, and no taxes on withdrawals from medical expenses. A key change for 2026 is that you can pay for those subscription plans to primary care providers directly from your HSA. So if you use like a concierge primary care doctor or something similar to that, where you pay for access, you can make those payments directly from your HSA effectively using pre-tax money, even if you just put money in there and then sending it out the same year. Obviously, you can also save money in there for long term, right? Long term, I'll just remind everybody of this. Everybody has healthcare expenses eventually, right? So having a war chest built up to cover those healthcare expenses that's tax free in retirement can be immensely valuable. We talked earlier about being able to control your taxable income in retirement. Healthcare expenses don't always come when they fit nicely into our tax plan, so it can be super helpful as your family ages to have a place where you can go pay for some of those unexpected medical expenses that doesn't change your tax situation for a given year. Real estate strategies. Real estate can be a really powerful tool for reducing your taxable income over the long term, whether you're a business owner or an individual investor. This is especially true if you're married and you've got one spouse that can work full-time in your real estate business and qualify as a professional. That allows deductions for depreciation, mortgage interest, all those things on those rental properties. But you have to have somebody that can work full-time, right? So I hear this from a lot of folks. They're like, hey, well, maybe my spouse can sort of kind of work full-time. Not the case. You got to track your hours. It's got to be a real job. So in order to get the benefit, you got to really do the time. But it can be a really powerful deduction if you can dedicate your time to it. You can also participate in 1031 exchanges in real estate. That allows you to defer capital gains taxes when you sell a property by reinvesting the proceeds in a similar property. That strategy lets you continue growing your investment portfolio without the immediate kind of capital gains hit that you would otherwise incur. Again, the key is that. So let's talk about Trump accounts. You can claim Trump accounts for your children on this year's tax form. So if you had a new baby in 2025, congratulations. The federal government's going to put $1,000 into this account for your newborn. The problem, that program's going to last for a few years. There's no downside to claiming the account for your newborn. It's a free $1,000. It's going to grow tax deferred. You may as well claim it. I would caution against making additional contributions to these accounts, at least for now. They're essentially like after-tax contributions to an IRA. You don't get a tax deduction for the contribution that you make. The entire balance and the associated growth then gets taxed as ordinary income when it's withdrawn. So you pay income taxes twice on the money. So I'd consider a sort of standard taxable savings accounts for your kids that don't have earned income, and then perhaps Roths or IRA accounts when they start those summer jobs or have a situation where they can have some reportable earned income on their return. So claim the account if you had a baby last year, but I'd be thoughtful about making additional contributions to those. Lastly, on the state and local front, both Alabama and Georgia are reducing taxes. Georgia's cutting the tax rates from last year, and there's proposals in the state legislature this spring for further tax reductions over the long term, so look out for that. And then Alabama is doubling the retirement income exemption from $6,000 to $12,000. So both states, there's opportunities for your state tax bill to move lower. For our Tennessee clients, there's obviously no income tax, so there's no changes, significant changes there. So in closing, if you remember nothing else, remember that taxes are a long-term game. The most important things that you can do are those long-term strategic choices that we talked about. Structuring your business entities the right way, contributing to the right kinds of retirement accounts, evaluating those decisions every single year. That difference can add up to hundreds of thousands of dollars over many years. That's far more than a few extra deductions are going to get you in 2025 and 2026. So if you have questions about tax planning or about integrating your tax planning in your investments, reach out anytime. We'd be happy to talk with you further. And we will see you next time on the Capital Stewards Podcast.